You've seen them, right? Those ads all over the internet promising you can make big money, and fast, just tapping on your phone. Well, behind that really slick promise, there's a much tougher reality. So today, let's pull back the curtain on this whole easy money thing and figure out why, for so many people, it's actually just a trap.
Okay, let's just start with one single number, 71%. Yep, according to one of the big investment providers, that's how many retail accounts lose money trading one very specific type of product. Think about that. That's more than 7 out of every 10 people. So you've got these ads promising huge profits on one side, and then you've got this statistic on the other. It doesn't add up, right? So what is really going on here? What's the hidden piece of the puzzle? The actual mechanism that's causing so many people to lose their money?
All right, to get to the bottom of this, we've got to look at the financial tool that's at the very heart of all these ads. Let's dive into the product itself. So this product is called a contract for difference, or you'll see it as CFD. Basically, it's a way for you to bet on which way the price of something is going to go, a stock, a currency, gold, without ever actually owning the thing itself. And here's the kicker, it has one feature that is incredibly powerful and incredibly dangerous.
And that feature, it's called leverage. The best way to think about it is like a financial superpower. It can make you feel like a hero, but man, it can turn against you in the blink of an eye.
So here's how it works in really simple terms. Leverage lets you put down just a tiny little deposit, that's called your margin, to control a much bigger position in the market. The key word here is amplify. It makes everything bigger.
And just look at how powerful that amplification can be. This example comes straight from a European regulator, ESMA. They show that with just 500 euros of your own cash, your margin, a broker can let you trade with 10,000 euros. That's 20-to-1 leverage. That's wild.
Okay, and this is where you really see the double-edged sword in action. Let's say the market goes up just 3%. Your 10,000 euro position just made 300 euros. Now on your little 500 euro deposit, that's a 60% profit. I mean, that's amazing, right? But here's the flip side. If the market goes down by that same 3%, you lose 300 euros, and that's a devastating 60% loss of your own money. So here's the really crucial thing to understand. It's not just about making your losses bigger. High leverage sets up these three very specific traps that just systematically wipe people out. It's almost like a system.
So what are they? Well, first, you've got the amplified losses we just talked about. Second, there's something called a forced closure, which is exactly what it sounds like. Your trade gets shut down whether you want it to or not. And third, there's this kind of hidden drain from all the costs and fees. Okay, let's break each one of these down.
All right, trap number 1. With really high leverage, we're talking like 100-to-1, your room for error is basically zero. It's razor thin. The regulator, ESMA, points out that if you bet the market's going to go up, but it just dips by 1%, your entire investment is gone. Just poof, vanished.
Okay, trap number 2 might be the most frustrating one of all. This quote from a Reddit user just nails it. You can actually be right about the market and still lose all your money. How? Well, imagine you predict a stock is going to be up by the end of the week. Great. But what if it takes a sudden, sharp nosedive on Tuesday? Your broker's system will automatically close you out. It's called a margin call, and it happens so you don't lose more money than you deposited. But the end result is you're wiped out, even though, come Friday, you were proven right all along. It's brutal.
And that brings us to trap number 3, the slow bleed. See, every single time you make a trade, there are little costs. Fees, commissions, something called the spread, which is just the tiny gap between the buying and selling price. And as one broker points out, all these little costs, they don't just come out of your profits, they eat directly into your margin. They shrink your safety net, which makes you way more likely to get hit with one of those forced closures we just talked about.
So when you look at it, the actual mechanics of this are they're stacked against you. Which of course raises the big question. If this game is so tough to win, why do so many people keep playing? Well, the answer isn't in the math anymore. It's in our heads. It's psychology.
When you read through what traders on Reddit are saying, you see this powerful psychological mix at play. First, you get a small win, and because of the leverage, it feels huge. Suddenly, you're not lucky. You're a genius, right? Then you lose, and that's when the sunk cost fallacy kicks in. That feeling of, I just need to invest a little more to win back what I lost. And on top of all that, for a lot of people, the pure thrill of it, the ups and downs, it just becomes addictive. It's not really investing anymore. It's gambling.
And this cynical view gets summed up perfectly in a really stark anecdote shared on Reddit. It comes from an insider who was listening to an IPO pitch from a big CFD broker. And he recalled their business model was, well, brutally simple. They didn't even bother to hedge their clients' trades. Why? Because, and this is a direct quote, their view was, our customers are idiots, they will always lose money.
So, you take this really dangerous product, you combine it with very predictable human psychology, and what do you get? You get a problem so big that eventually regulators had no choice but to step in.
And that's exactly what happened in Europe. The sheer scale of people losing money just got too big to ignore. At first, individual countries tried to act, but eventually the big pan-European regulator, ESMA, they stepped in. They basically decided that the industry couldn't be trusted to police itself anymore. They had to put some rules in place to protect everyday people.
So, what did ESMA do? They rolled out this whole package of protections. First, to tackle the biggest trap of all, they put strict limits on leverage. To stop those sudden wipeouts, they made automatic closeout rules mandatory. And this next one is huge. They brought in negative balance protection. That means you can never lose more money than you put in your account. And finally, they're the reason you now see those big standardized risk warnings on all the ads.
And this really just lays out the fundamental conflict perfectly. On one side, you have the regulators like ESMA trying to put up guardrails and make the market safer for people. And on the other side, you have what one source calls a churn and burn business model. A model that basically treats new traders like a commodity. Get them in, profit from their losses, and when they get wiped out, just find the next person in line.
And so, here we are, right back where we started. The ads promise you a simple game of skill, a chance to get rich quick. But the reality? It's a system that feels like it's designed to make small losses huge, to kick you out at the worst possible time, and to use your own psychology against you. It really leaves you with one big, final question to think about. When a game is this hard to win, who was it really built for?